Hi, everyone. Today I want to talk about Realty Income. Realty Income is a publicly traded real estate investment trust. They invest in any kind of commercial real estate that you can think of, from big box stores to wholesalers to even places like FedEx. They are a dividend aristocrat and they pay monthly. Is Realty Income a buy right now? Let's find out. If you have big dreams like buying the new McLaren 600 LT Sagastria Borealis, go ahead and like and subscribe. Only 12 of them will be made, and they are meant to represent the Spider. They come with 600 horsepower, and they sell for only $278,000, which is cheap for a limited production vehicle. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So who is Realty Income? They are a real estate investment trust that focuses on buying commercial properties and renting them to different companies. As you can see here, they've averaged 14.6% returns. They pay a 4.5% dividend, and they have paid 598 consecutive monthly dividends. So let's start with assets. They own over 6,500 different commercial properties. They currently have a 98.5% occupancy, and all of those properties are spread across 51 different industries. It says here their goal is to identify, evaluate, and execute opportunities in order to protect and enhance the value of their portfolio. This means they are willing to go out and buy properties and build a new structure to accommodate new customers, and not just buy old assets and continue to rent them. They are innovative in the realty space, and they are constantly expanding. They also have ancillary revenues like purchasing ATMs, cell phone towers, solar arrays, billboards, and even electric vehicle charging stations. Let's dig into who some of their top tenants are. So these are organized by revenue from top to bottom. So Walgreens pays them the most amount of revenue, followed by 7-Eleven, Dollar General, FedEx. So I'm going to highlight AMC Theaters here. They are going to have some issues, as well as Regal Cinemas. Both of these companies are going to struggle with the cough situation. And I know AMC specifically is struggling, so it'll be interesting to see how Realty Income copes with those issues. Otherwise, the rest of these companies seem like they will be stable. Companies like Kroger and Home Depot are definitely going to be fine. Walmart, Sam's Club, Lifetime Fitness. I really believe a lot of these companies are going to survive the cough situation and continue to pay their rents into the future. So let's talk about diversity. These are all the different industries that their renters participate in. Everything from aerospace to customer goods, childcare to drugstores. It's a pretty wide range of things. Anytime that you can profit from childcare, as well as aerospace industry or automotive collision services, you have a company that can weather a significant amount of market turbulence. Going on down the list here, they have drugstores, education facilities, electrical utilities, financial services, food processing, grocery stores, healthcare, health and fitness, home improvement, all the way down to office supplies, packaging, paper, shoes, sporting goods, telecom, and wholesale clubs. Those are all in the United States. They also own some grocery stores, healthcare, and theaters in the United Kingdom. Moving on to a little bit of geographic diversity. Let's look at some of these different states. Texas, 803 properties. Oklahoma, 191. Montana, 12 properties. Pennsylvania, 224 properties. New York, 136. North Carolina, 202. Florida, 432. Oregon, 29. Nevada, 24. Utah, 23. North Dakota, 8. Minnesota, 173. The idea here is they have properties in every single state, and that they are not beholden to a specific economy or a specific area in terms of their income. They are spread out, and that helps them have a steady flow of income. So let's talk about property type composition. The vast majority of their properties are in retail. 6,348 of them are in retail, and that makes up the bulk of their income, about 84% of it. The rest of it is in office and agriculture, as well as some industrial. For the first quarter, their rental revenue was $390 million, and that is from all of their 6,525 properties. Just to give you a different picture, 83% here from retail, 11.5% from industrial, office at 3.7%, and agriculture at 1.8%. In terms of occupancy, they have never been below 96%, and they are currently at 98.5%. Moving on to total number of properties, they've been ramping up pretty dramatically, and they are currently at 6,525 properties. And then here you can see total number of vacant properties, only 97 of them. So I talked about how they are growing. So here's some of their criteria for purchasing new properties. They prefer single tenant properties. They prefer leases of 10 years or more. However, they do consider some shorter leases. And they, of course, like real estate that is in a strategic location. All right, let's go over the Morningstar Report a little bit. On May 4th, they were at $50.61 per share. Current estimated fair value is $65 per share. Current dividend, 5.42%. Forward dividend, 5.52%. That is because they grow their dividend every single time. And this is the main thing here. Stewardship is considered to be exemplary. Their revenues have held up better than anticipated during this cough situation. I'm not going to go too deep into this, but they have thousands of properties. Their business model is to have quality tenants and quality structures and continue to have long leases and extending those leases to ensure regular income. They are currently a dividend aristocrat. They have a credit rating of an A- or better, and that really makes them one of the most dependable assets to own. Their average annual rental income increase is only around 1%, which is not an incredibly fast rate of growth. However, they have a very strong base of rental income, and they do grow it consistently. The company has executed $15 billion in acquisitions over the past decade. It says here they don't anticipate any changes from the fair value. It does say that releasing spreads were down 1%, which has not been a huge impact to Realty Income. And their earnings per share was at 88 cents, which was a penny above the consensus. That is a 7.3% growth from first quarter of 2019. It says here management did withdraw their guidance along with most of the other companies in the S&P 500. However, they did collect 82.9% of their rent, and that is much higher than was thought to be paid based on this cough situation. Let's talk about the bulls and the bears. So the bulls say that Realty Income is a reliable, slow-growing monthly dividend company. They have large amounts of liquidity with reasonable leverage, and their operating history and defined underwriting criteria and expanded portfolio transparency should give shareholders comfort while also maintaining management accountability. In other words, they're just a well-managed company, and they have been consistently stable. So this is not a growth company. This is a dividend-paying company, and you shouldn't expect incredibly rapid growth. However, in my opinion, they're currently undervalued. So if you can get it at this price, then there is significant potential for growth along with their good dividend payments. The bears say they have been taking on a greater volume of risky investments in order to please shareholders, which could be pushing Realty Income to take on a little more risk than they have been accustomed to. It says further that because of their long-term lease format, it does make them a little bit more susceptible to rising interest rates as well as inflation. And if interest rates rise, then that will cut into some of their profits in the form of financing costs. Let's talk projections. So the blue line is current return, the yellow line is quantitative fair value, and then this dashed line is projected value. They're projecting a $72 price per share at the end of 2021. So that's what I mean by pretty substantial growth. So that would be almost a 50% growth from where we're at right now. So if you can get a 5% dividend along with getting a potential of 50% growth per share, then that makes this a very attractive stock. So looking at financials, looking at net income has gone up every year. This year, they are expected to keep the same net income. Of course, they did withdraw their forecast, so this is a little bit of speculation, but they are expected to at least maintain the same amount of income this year as they got last year despite this cough situation. Their revenue for last year was $1.49 billion, and their dividends per share was $2.72. In terms of profitability, they had a 4.9% return on equity and a 2.6% return on assets last year, and then a percent margin of 29.3%. So it's a pretty healthy margin. And then long-term debt, they did take on some debt last year, so they currently have $7.9 billion in long-term debt, and this gives them an operating margin of 49.8%. So to summarize, Realty Income Corp is a large real estate investment trust with thousands of properties. They have a history of paying dividends every single month. They average a 4.5% dividend, and they are currently yielding almost a 5.5% dividend, and they have potential growth to $72 per share. They have a very stable and diverse set of assets that pay rental income, and in my opinion, this company is currently undervalued. Of course, this is not financial advice. Please consult your financial advisor before making any decisions, and this is all for entertainment purposes. And with that, let's get to some jelly. So today's jelly is Peyton Manning picking on Tom Brady. They recently did a fundraiser golf tournament with Phil Mickelson and Tiger Woods. And here's a shot of him roasting Tom Brady a little bit.
Brady, we were talking, he would have brought Gronkowski because Gronk does whatever Tom asked him to do. Gronk will wrestle, take a year off, come play in Tampa with me later, come caddy for me. It's hard to get to him, right? But, do you bring Eli? Could do that. You bring Nick Foles, maybe. Cheap shot.
So there he was suggesting bringing his brother Eli or Nick Foles, which are the two quarterbacks that beat Tom Brady in the Super Bowl. And Peyton is always a pretty funny guy, and I appreciate the fact that he is picking on Tom Brady. Although, to be fair, I am excited to see Tom go play in Tampa Bay and see if he can play well without Bill Belichick as head coach. Go ahead and comment down below what you think of Realty Income Corp or the new and improved Tampa Bay Buccaneers. Make sure you like and subscribe so you don't miss any of my future videos, and have a great day.